This week, my daughter got her mission call, and it's different now. Now that it's like it comes through email and stuff. So our first two that went, it was all like the old-fashioned letter way, and this way it was like she submitted it, and then it said ready for assignment, and then she had it, and it was like super fast. And so that was kind of weird. And then in the middle of COVID and everything, there's our community here, the kids really like to like have all their friends come over and have like 80 kids packed in there, while you're opening your mission call. And I was trying to find the balance of that, but I've learned that with this particular daughter of mine, there's no finding balance. She's going to put it out there on social media, and people will show up at our house. And so hopefully we didn't have a super spreading event while opening a mission call. She's going to Birmingham, Alabama, which I think will be a culture shock for a little girl from Safford, Arizona. It'll be it's a different. All of my kids have gone to the South, so and I've decided that Southern missions are hard. They're challenging. So anyway, there's a little something from my life that has nothing to do with accounting, except for, I guess, my ability to do accounting helps pay for those missions. See, there's always a connection. I always tell my students that accounting is not 18 or 20-year-old sexy, but it's 40-year-old sexy. 40-year-old sexy because by the time you're at that level of career in accounting, when you're 40, you're making about $120,000 a year, and you're usually working 9 to 5, except during tax season. That's pretty sexy. It's consistent and steady. But it doesn't sound that exciting when you're 20. You're like, you know what I want to do? I want to be crushed by the numbers. Anyway, so I got a couple little slides for you on this week's content. You probably have already interfaced with some of this just in doing the first part of the homework. But I wanted to go through just a couple things. I always find that people are kind of like interested in the stock stuff. Even though, let's see, I think that'll do it. Honestly, this type of accounting that they're doing, or it's talking about stock and stuff this week, most accountants don't deal with this. Like, honestly, like this is only accountants working for large corporations and on the finance side of those corporations. So most accountants we're doing personal accounting or a lot of small business accounting. Or even in large businesses, they're doing cost accounting or managerial accounting, and only a handful are working on the finance side. And so I think I've always thought it was interesting that this is included as, stuff we should know at the basic level for accounting. Because what's going to happen is, even if you decide to be an accountant, you're going to forget a lot of this. Then you're going to take a intermediate accounting course, and then you're going to take more specialized accounting courses, and you'll end up then passing the CPA exam and then going to a firm, and then you're going to get even more training in the specific things they want you to do. So what I would say is we have to learn this for the purpose of the class. I teach this same class at other colleges. It's in every single one, so it's not just BYU wants you to learn this. But I guess is like I don't worry too much about like getting any deeper than what the textbook goes for this sort of stuff. So that'd be my first sort of caveat. So the whole concept of par value stock is weird, and honestly, it's a vestige of like an old system, but it still exists because each state has the authority to grant corporate status to businesses that are formed in that state. And so some states still do par value stock. So when you create your corporate charter, the state actually says, makes you declare a par value for your stock. And par value means nothing, honestly. Like there's no deeper meaning. People are always like, okay, I get it, but like what's it mean? It means nothing. It's an arbitrary number that's put on the corporate charter. So for example, we have this Hydroslide company. They issue 2,000 shares of $1 par value common stock. And then wants us to prepare a journal entry if 1,000 shares are issued at $1 per share, or if 1,000 shares are issued at $5 per share. So all it means is we have to record the value of the stock being issued at the par value, and then record any value over and above the par value we received separately. It doesn't mean anything. In other words, if a company didn't have a par value, some states don't require a par value, then we would just say we received $5,000, or, on the second one, $5,000 for 1,000 shares of stock, and that'd be it. So I guess what I'm saying is don't get too buried in what par value means, just know how to record it. So in the first one, if they issue it for $1 a share, then cash goes up $1,000, common stock goes up $1,000. If they issue it for $5 a share, they show cash going up by $5,000, the common stock account going up by the par value, which is 1,000 shares times $1, $1,000, and then any money over and above which the par value gets recorded to an account called paid-in capital in excess of par value. I mean, honestly, what we need to know is that we got a certain amount of cash, and then this is the value of it, how we're going to list it on our books. So some states don't require par, so it would just be cash, $5,000, and it'd be common stock, and usually they'll put no par next to it, $5,000. But in states where they have par value, all you do is you record the par value, and then any money over and above that is called paid-in capital in excess of par value. So strangely, I just told you that this was silly and not to worry about it, but that you still have to know how to do it. Welcome to government. Okay, that's honestly, this is all the fault of state governments, and mostly because they just have varying laws. You think people from other countries ever come to America and are like, so wait a minute, the laws here aren't the same as the laws in, like in Arizona, you can just carry a concealed weapon with like no permit, no nothing, because it's Arizona. That's their rules here. But in other states, you could get arrested for that, right? I think people must wonder if they like give you like somebody meets you at the border of the state and like gives you a little list. It's like, here's the laws here. It's weird. Crazy Americans. All right. What this would look like on our balance sheet is it would show the common stock. So this company issued, like we just recorded, $1,000 at $1 a share. I mean, 1,000 shares at $1 a share, and then 1,000 shares at $5 a share. So we'll end up with it showing common stock of $2,000 and paid-in capital in excess of par, $4,000. So that's their total paid-in capital. The reason we call stock money we bring in from issuing stock paid-in capital is because the people who purchase stock become owners in the company. And so paid-in capital just means any of the company's assets that were received by the owners paying into it. Okay, so in a more simple sense, so I own a small company. My mother and I are partners in it, and we each contributed $40,000 to the founding of this company. And so the company had $80,000 in cash when we first started as an asset. That money didn't come from any earnings we made. It came from contributions by the owners. So paid-in capital is just money or assets that the business has. Remember that assets equal liabilities plus equity. So if your assets go up, cash in this case, you either had to borrow it, liability, or you had to have equity. And the equity only comes from either the owners paying it in, that's the paid-in capital, or from earning it, and that's retained earnings. And that's it, right? I mean, that's back to day one, that fundamental accounting equation. But that's how it all plays in here. All right. So the second thing that's sometimes confusing to people is what's called preferred stock. The reason it's confusing is because almost no normal people ever deal with preferred stock. Preferred stock is like limited to like insiders of the company, you know, members of the board of directors or high-ranking people in the company. And it's called preferred stock because it gets preferred treatment with respect to dividends. So if the board of directors approves a dividend, which means a payout of the share of the company's profits, the preferred stock gets its dividends first, and then any amount left over goes to the common stockholders. What's interesting, though, is even though it's called preferred stock, which would make you think it has other privileges, preferred stockholders don't get any voting rights. So they don't get a chance to choose the board of directors. So it's preferred in relation to dividends. And then one other thing here is in the event of liquidation. And that means if the company goes out of business and then we sell off all the assets of the company and use that money we earn from selling the assets to pay off the debts, any amount left over belongs to the stockholders. And the preferred stockholders are going to get their share first and the common stockholders second. Okay, so that's what the preferred and preferred stock means. Just like with the common stock, most preferred stock has a par value. So when we issue it, we'll have to record a certain amount of that issuance at the par value, and then any amount in excess of that will be paid in capital in excess of par. So here's an example. The Stein Corporation issues 10,000 shares of $10 par preferred stock for $12 per share. So our cash will go up if we do 10,000 shares times $12 per share. Our cash will go up 120,000. The preferred stock account will go up 10,000 shares times the par value, $10 per share, so 100,000. And then the paid in capital in excess of par on preferred stock will go up by the remainder, the 20,000. So it's the same process there. And just like with the other stock, some preferred stock has no par value. It depends on the state's laws where that stock is issued. Third concept that confuses people is treasury stock. So treasury stock it's always common stock, okay? And it's stock that has been authorized by the corporation and then issued. So it's out there for people to trade. And then the corporation buys it back in, or it's reacquired by the corporation. Corporations do this for a couple reasons. The biggest of which is if I sell off a part of my company because I need money, and then I earn some money and now I don't need money as badly, I might want to buy some of my company back so it's not owned by other people, right? So I have more decision-making power when it comes to electing a board and things like that. So we reacquire stock to get it off the market and have it owned by us again. I mean, I know if I had to sell off a part of my company, I would only do that if I really needed the money, and then I would try to get it back as quick as I could, right? So that's the one reason. Another big reason that they do it is for employee stock ownership plans. So if you've ever worked at a place that allows the employees to buy some ownership in the company, instead of being dependent on the market value of the stock, the company can actually buy stock, hold it as treasury stock, and then distribute it to employees in their plans, and that gives them a little more stability. They know exactly what it's going to cost them to distribute that to the employees. Anyway, so just know that treasury stock is common stock that has been reacquired by the company. So here we have Mead Incorporated, and we can see that they have common stock, $5 par value, 400,000 shares authorized, 100,000 shares outstanding. I can tell by looking at it if it's $5 par and 100 outstanding and it's worth 500,000 and there's no paid in capital in excess, that they must have issued those at $5 a share. See, I can tell some things by looking at that. So they reacquire 4,000 shares of their stock at $8 per share. So all we do to record that is we debit treasury stock by the amount we pay for it. So nothing to do with the par value, just what we pay for it, 32,000, and we credit cash. So you'll notice that every other part of stockholders' equity has a credit balance, a normal credit balance. But treasury stock has a debit balance. And the reason it does is because it actually reduces. Remember that my common stock account represents capital paid in by the stockholders, the owners of the business. And so treasury stock is actually going to offset or reduce the amount of my business that's owned by shareholders, okay? And so that the normal balance for treasury stock is on the debit side. That's the part that's a little weird sometimes.
So if you have, it's like in the homework, it said like they have maybe $40,000 worth of treasury stock, and then they issued another 7,000. It's always going to be a debit, right? You're going to just add those two together, what they had originally and then what you journalized, and that's going to be in the debit column.
Yeah, so if they purchase, so you don't issue treasury stock, you purchase it back from the open market.
Okay.
But yes, and what's interesting about that is So you'll debit the treasury stock account and credit cash again.
Okay.
But you might have treasury stock that you purchased, like these guys just purchased it for, what was it, $8 a share, and then maybe another time they purchased it for $5, and it all just gets lumped in together. And so it's the treasury stock account's debit balance is the market price that the company paid to reacquire that stock.
Okay.
Okay. So here's what the balance sheet will look like after they reacquire that. So you have the whole stockholders equity section, and then after it, there's always one more line before you do the total that's less treasury stock, and you subtract out the cost of that treasury stock, and that gives you your total stockholders equity. And what's interesting is we'd issued, so before we had 100,000 shares outstanding, issued and outstanding. Now we have 100,000 shares issued, but only 96,000 of them are outstanding because 4,000 of them were bought back into treasury stock. Anyway, again, that helps an investor looking at the company to see, okay, even though there's 100,000 outstanding, really only 96,000 are available for sale. Which means if I'm a rich guy, I know how much I can buy before I have to start reporting to the SEC because it looks like a hostile takeover. But that's a different class, way beyond it. That's the cool stuff. How come in beginning classes you always have to do the boring stuff? Have you ever noticed that? Like, I love economics, but college economics, the first classes, those are just misery. I'm sorry. All right. So dividends, like I said, that's money that we, like a share of our profits that we pay out to the stockholders. And there's a couple ways we can do that. One's called cash dividends, where we're actually paying cash. So in order for that to happen, the company has to have retained earnings, have enough cash, and then have the board of directors say, yes, we're going to pay out cash dividends. So here's an example of how that will happen. This is Media General. They have a 50-cent per share cash dividend on 100,000 shares of $10 par value common stock. That's a lot of information right there. So if they're going to do 50 cents per share and they have 100,000 shares, that means they're going to pay $50,000 in total dividends. Okay. So you're going to debit cash dividends, and sometimes in real life it just is big dividends. For this book, they're trying to separate cash dividends from stock dividends and make it clearer for you. And then at the declaration date, so as soon as the board of directors says we're going to pay a dividend, this journal entry gets entered by the accountants on the books of the company. Cash dividends, debit, dividend payable, credit. Then they have the record date, and that's the date which means if you own the stock as of this date, you're going to get paid this dividend. But there's no entry that actually occurs at that time because there's no financial transaction occurring. Finally, on January 20th, the payment date, we'll debit the dividend payable because we no longer owe that because we're actually going to pay it, and we'll credit cash. And then what's not on here, but if you remember all the way back to like the 4th chapter where we talked about closing entries, is the dividends will get closed out at the end of the period to the retained earnings account, and it will reduce the amount of retained earnings. So remember, retained earnings is when we make a profit and we hold that in the company, we retain it for some future use, and then a dividend is paying out a portion of those retained earnings to the shareholders. Okay. So like even like my little company that my mom and I are partners in, we have a small amount of money we retain in there. And this December, I think we'll each take a dividend of $1,000 each. So kind of like Christmas money, you know, I'll just write a check to my mom for $1,000 and write a check to me for $1,000. And then that's how we'll record it. Our cash goes down and our cash dividends gets recorded as $2,000.
So I have a question on that. For some reason, it's not making sense. If you are paying out cash and so you are crediting the cash account, then why are you also crediting the retained earning? It's almost like it's taking it from the retaining earnings and it's taking it from the cash.
Right. No, we'll actually be debiting retained earnings. So when we do the closing entries at the end of the period, at the end of the year, so since we didn't pay, so since we've recorded the dividends here on December 1st, on December 31st, our cash dividends account will have a debit balance of $50,000.
Okay.
So to close that, we'll credit cash dividends and then debit retained earnings.
Okay.
And so that will have the effect of reducing our retained earnings to do it.
So you're reducing your retained earnings in order, but I'm still not getting it. Because you're reducing retained earnings, but then you're reducing cash too.
Right. So think of it like, think of the fundamental accounting equation, assets equal liabilities plus equity. So when I pay out, so when I do this first entry, okay, I'm creating a liability.
Oh, okay.
Now when I
Okay.
pay
Yes.
it, I'm getting rid of the liability and getting rid of cash. That's got to come from somewhere, and that's from dividends closing out to retained earnings. So I'll be reducing cash and reducing a liability, and then we'll still be in balance. I mean, sorry,
Okay.
reducing cash and reducing equity, retained earnings.
Okay. Okay. Thank you.
All right. So there's another weird feature about a preferred stock that's worth mentioning, because I think they'll have it come up in the homework. I mentioned that preferred stockholders have the right to receive their dividends first, but a lot of preferred stock has something called a cumulative dividend. And what that means is if there's a year where the company doesn't have enough money and doesn't pay a dividend, then they still earn their dividend, they just don't get paid it until the next time the company pays dividends. And so then, so they have something that's called dividends in arrears, meaning dividends that are owed to them from previous periods when they weren't paid. So let's say last year the company doesn't pay a dividend, and this year they decide they are going to pay a dividend. What they'll do is they'll come up with a certain amount of dividend they'll pay, $1 million or whatever they're going to pay. And then the first thing you do is say how much of this belongs to the preferred shareholders for their dividends in arrears from the previous year. Second thing is how much belongs to the preferred shareholder or preferred stockholders for this year. And then whatever's left over goes to the common stockholders. So common stock never has that feature. Either you get a dividend or you don't, depending on whether they do one or not. But a lot of preferred shares have this sort of like guarantees. They're going to pay this much of a dividend, and if they miss a year, that'll have to be paid up before common stockholders will get anything. Okay, so you'll probably see that in the homework if you haven't yet. So here's Scientific Leasing, 5,000 shares, 7%, $100 par value, cumulative. So this term cumulative right here is how you can know, how you can know if the stock, the preferred stock, has the ability to have dividends from previous periods or dividends in arrears. Okay, so so when it says with preferred stock, if it says it's a 7% stock, that means it's guaranteeing a dividend of 7% of the par value. Okay, so for 7%, $100 par value preferred stock, that means it's supposed to pay $7 per share of preferred stock. So if there's 5,000 shares of that, then it's going to pay 5,000 times $7, $35,000 worth of dividends in a given year. So this one says the dividends are 2 years in arrears, meaning this company has not, either because they didn't have the money or something, they had not paid dividends for 2 years previous. So when they issue their stock, they're going to pay back the last 2 years in arrears, plus this year's dividends, and that's all going to go to the preferred shareholder before the common stockholders get anything. Okay. Let's see. And so there are just a couple more concepts. So sometimes a company wants to pay a dividend, but they don't have a lot of cash. So the reason you pay a dividend is usually to reward shareholders for, investing in your company and helping you have the money you need. And so sometimes what they'll do is they'll pay a stock dividend, which means they'll issue new shares of stock and give the shareholders stock instead of cash. So I just wanted I like this little illustration shows nicely what happens. So here they declare a 10% stock dividend on their $10 par common stock, and there's 50,000 shares outstanding. So the way that works is if we say a 10% dividend, we're going to multiply 0.1 or 10% times the number of shares outstanding, which means in this case they're going to issue another 5,000 shares of stock. So that way anybody who has stock, if somebody owns 1,000 shares of stock, they'll get 100 more shares. If somebody owns 10 shares of stock, they'll get one more share. Okay, it's a 10% stock dividend. So before this, you can see that they had $500,000 in common stock, retained earnings of $300,000, so their total stockholders' equity was $800,000, and they had 50,000 shares outstanding. When they issue these additional 5,000 shares, now you'll see that they have, and the market price is $15 per share. So what they're going to do is do 5,000 shares at the par of $10, which will make the 500,000 go to 550. Plus there's an additional $5 in capital in excess of par. That'll become 25,000 there. So their total paid in capital will now be 575. And you'll see their retained earnings goes down by that amount. So we're issuing these new shares of stock, and the question is, what's paying for those new shares of stock? And the answer is retained earnings, because that's how dividends work. We pull money out of retained earnings, and in this case, it just gets added into the common stock account. So you'll see that the total stockholders' equity actually didn't change, right? So what happened is common stock account and the paid in capital and excess of par accounts went up, but the retained earnings account went down by the same amount. And so it ends up with the same value in total stockholders' equity, and now there's 55,000 shares outstanding. So that's how a stock dividend works, and that can be a little confusing at times. And then there's a stock split. So sometimes certain companies like to keep the market price of their stock at a certain level. The reason being is because investors just become less and less interested in investing in a stock if it's super high in price. So sometimes they just like to keep their market price at a certain target level. Other companies don't believe in that. In fact, some companies like Berkshire Hathaway, if you've ever heard of that, that's a company owned by Warren Buffett. They've let their stock price go crazy high. It's like $300,000 a share or something. I'd have to look it up. And I think their logic behind that is saying we don't want casual investors. We want large, hedge funds and retirement plans to be investing in this, who recognize and understand the inherent risks of our company. So it's a decision made sort of at the board of directors level, what price they want their stock to sort of be at. So sometimes they'll do a split. And so that would be like, what they'll do is issue more shares of stock, but they'll actually reduce in half the par value and the market value of the stock. So if I had 100 shares of a stock that was worth a market value of $50 a share, after the split, I would now have 200 shares of stock, but they're only worth $25 a share. So there's no change in value for me, but I now have more shares, and the market price is down within that target range they're looking for. So I just want to show you sort of what happens when they do a stock split. This is called a 2-for-1 split. They can do 3-for-1, 5-for-1, 10-for-1, and they can also do reverse splits, like 1-for-2 and things like that. So they're going to split their 50,000 shares of common stock. So you can see that their common stock account had 500,000, retained earnings were 300,000, total equity of 800, with 50,000 outstanding shares at $10 a share. When they split, you'll see that the amount of common stock doesn't change. The dollar value, it's still worth 500,000. The retained earnings doesn't change because we're not paying for the issuance of new stock. All that changes is the number of shares doubles, and the par value is cut in half. Okay. When I was a broker, I once worked with a lady who had a bunch of Coca-Cola stock that she just kept in a shoebox in her back room, and she wasn't aware it had split over the years. The transfer agent hadn't got her updated mailing address, and we found out that her couple hundred shares of Coca-Cola in the shoebox had split and split and split until she had, I forget how many shares she had. It was about $1.2 million worth of Coca-Cola stock in her back room. And she had no kids or anything. So I wanted her to adopt me, but instead she started a scholarship fund for the local kids, which is pretty cool. Yeah, it was crazy. All right. So this is just a summary of kind of what happens with stock dividends versus stock splits. And I wouldn't dwell on it too much. I just wanted to sort of show that. And I think that's all I have for you. That's plenty. I talked for like 20 some odd minutes, And now I need a drink of water. So maybe now more importantly is, do you guys have any questions that I might be able to answer, or maybe problems in the homework, or are we good? Are we doing all right?
I already asked my questions, but this, I haven't had too much problem, and I put a lot of time into this class, but this chapter and the last chapter, I feel like they were the hardest ones for some reason, and I don't know if it just they're different types of concepts that we've been doing. They're more detailed, or maybe my brain's getting tired. But do you find students do have a hard time with these, or
Yeah.
am I
So
just really?
no, yeah. So the first 4 chapters, because it's all new concepts at that point, and especially the adjusting entries, that gets people. And then these chapters, because I think it's less tangible. Like I can understand what a loan is. I can understand what an asset is, but the whole concept of like stockholders equity representing this money that people have either paid in or the business has earned is just more esoteric. And so you're not alone, I guess is what I'm saying.
So on the test though, is it pretty straightforward from what, like if you redo the practice skills and everything, is it pretty straightforward? And the questions are similar like it has been, the format?
Yeah, so I'll give you a qualified answer. I think like it has been is a good way to describe it, because the second part of that was going to be, has anything in the previous test led you to believe that straightforward is a good way to describe the way the exams go? I don't feel like they're very straightforward. Not that I feel like they're trying to trick you, but a lot of times they do come down to like, minute variations in the terminology, and they want you to read it super carefully.
Yeah.
Yes, the exam and its relationship to, say, the study guide is consistent with what it's been. Does that help?
Yeah, I know.
I love giving qualified answers. I should have gone to law school.
I know, it was kind of a random. I think I'm just venting a little bit because you guys are the only ones that understand. Like nobody else cares. That this is hard.
I mean, if you try to tell your teenage kids about it, they're just like, whatever.
Yeah, they're whatever. Yeah. I mean, I'm 45 going to school, my friends don't get it, nobody understands. So thank you. Yeah, that helps. Those questions that I was asking you during the presentation, that helped.
Okay. Braden, you have any questions or anything in the homework that you were stuck on or anything like that?
Yes. So I'll let you know, Tracy, that I felt so good about most of the concepts, but this one is getting me. So this one definitely feels harder for me, because I feel like everything else has been pretty, like you said, tangible. But this one's a little bit beyond me, so it's kicking my butt. The first problem in the second part of the homework is kind of like what we were talking about, the before and after dividend. And I feel like what got me was just there was so much more information in this one. So I was looking at a bunch of different numbers and I wasn't sure which ones I was supposed to use to solve it. So let
me pull it up and share it, and then we can just talk through it. Would that be helpful?
That'd be awesome.
Okay. Let me see here. When I pull it up on my end, though, it has all the answers in there, so we can't have like the reveal, right? It just has to be like, here's, but my answers are different than yours, so it's not like it'd be awesome and it just tells you the answer.
Right.
Like, I don't need to learn this, just give me the answers. Let's see, you said which problem?
11.6.
Brief exercise 11.6?
Yes.
Okay. Let me share my screen. Let's see, is that sharing?
Yeah.
Is that right? Is that the problem you're talking about?
Uh-huh. Okay. Yeah, so just on the part where it says let's see, the second sentence where it says, because the first column is all given to you, so that one's not too bad, but it's the second one, just the first part where it's common stock, So are you adding the number that you're adding to to get the after dividend of the common stock? Is that multiplying the 15% stock by the 21,000 shares?
Right. Yes. So that's the number of shares we'll be issuing. Right.
Mhm.
So this company has, let's see, stockholders. Let me read it before I start trying to explain things. Stockholders equity section consists of common stock, $9 par. I think that they're saying this is the number of shares we're issuing in the, let's see. One way I can figure that out is I can go 1,260,000 divided by the par value of 9, and I know there's 140,000 shares outstanding. And then I can multiply that by 0.15 and say, yeah, so we're issuing an additional 21,000 shares. So that's what they mean by that 21,000, is that's the number of shares we're going to issue with this dividend. So then it says when the market price per share is $15 per share. So our par value is $9. So I'm going to take those 21,000 shares and multiply it by $9. And that's the amount I'm going to add to my common stock account. So it'll be 1,260,000 plus another 189,000 in common stock. So let's double check and make sure that's right. 1,260,000. Yeah, so that'll be the new value of my common stock account. And then since it was $9 par and the market price is 15, there's going to be an additional $6 in paid-in capital in excess of par. Does that make sense?
Yep.
Okay, so I'll just do 6 times the 21,000 shares, and that'll give me the amount of paid-in capital in excess of par.
Gotcha. So then would the outstanding shares would be the one where you divided it to get the 140,000 plus the new 21,000?
Right. Yeah, so again, they didn't tell us that there was 140,000 shares outstanding.
Right.
We had to figure that out, right? And so something that they don't often explain is the way you figure out how many shares are outstanding is you just look at your common stock account balance, divide that by the number or by the par value per share, and that will tell you how many shares. So I have 1,260,000 divided by 9. That means I have 140,000 shares outstanding. I issued 21,000 more, so now I have 161,000.
Got it. That makes good sense.
I mean, it actually helped.
Yes.
Oh,
Yeah.
hashtag light the world. That was helpful today. Hey, I have a question for you guys. The hashtag give thanks thing. Did you see your social media feed like change for the better with that? Like it pushed out all the political crap, and like I ended up with like mostly actual posts by people I actually cared about, as opposed to just like political things. Did that happen to you at all? No? Okay.
Well, I don't do any, so I mean, being a single mom and a student, I don't do any social media. So don't ask me at all. I don't have Facebook. I don't have Instagram. I don't pay attention to anybody or anything. I live in a hole.
Okay. Like, I don't have time for that. I don't have time for.
I don't have time to give thanks.
I don't have time for social or for media. Right. Okay.
I don't know. You should ask these younger kids.
I saw a yes on there from somebody, and I saw Braden nodding his head. And I didn't see Erin do anything because I just have a still picture of her. But I think behind that still picture, she's nodding. All right. All right. Anything else?
Nope.
Braden, are you good, or did you have any other ones?
I have another one.
Oh, okay. Yeah, I mean, if other people have a chance and they don't speak up, man, you don't feel bad about dominating the floor.
No, and they're just little ones. So on problem 11.2a, where you're doing the journalizing.
This is a big honker of a problem.
Yeah.
That's the technical term for it, big honker.
So where on November 1st, the first one on November 1st, the dividends payable to cash.
Mm-hmm.
That one made sense. I guess our numbers are going to be different. But then what changed between that entry and the next one? Because I thought that you were just doing dividends payable, and I thought you were just balancing out that account. So I thought it would be repeating that same number again. Where does the 199,200 come from?
Sure. So on December 1st here, they declared another a dividend for their common stockholders. So on the one up here for October, and then in November, that was a dividend for the preferred shareholders.
Okay.
And then on December 1st, they declare an 80-cent per share cash dividend to common stockholders. So I have to look up here and say, okay, how many shares do I have of common stock out? And it looks like it's, let's see. So this one's kind of tough because I have to say, to begin with, common stock, this one, instead of calling it par value, they call it stated value. It's the same exact thing. Different states use different terms in their corporate charters. But I can do the same thing. I can say I have $1 million, and it's $4 stated value right here. So if I divide that by 4, I'm going to say the stated value, the stated value per share is $4. So there's 250,000 shares outstanding when I get started here. Then on February 1st, I issue another 5,000 shares. Now I've got 255,000 shares outstanding. So on December 1st, let's see, oh no, then they purchase 1,000 shares of treasury stock. So I've got to take 1,000 out of the outstanding. See how it's kind of complicated?
That was one of my questions, if you had to take treasury away from that.
Yeah.
So
So in essence, what we have to do is when we get down to where they declare this cash dividend for common stock, we have to know how many shares of common stock are out there. So I have 254,000 shares of common stock times 80 cents per share.
But wait a second. You have to do the treasury stock that's up there on the sheet. So
Oh, you're
you
right.
have to minus.
You're right.
Because I had problems on that. That's the one I just got done. So you have to minus.
Yeah, you're right. So I've
5,000
got 250,000 shares. I got that by taking my million and dividing it by 4. But then I subtract out 5,000 shares of treasury stock. Then I can come down here and say, oh, I issued 5,000 shares. And then I purchased 1,000 shares of treasury stock. So I've got 249,000 shares times 80 cents per share. That's where the 199.2 comes from.
Gotcha.
So
because if you get that wrong, it makes like 3 problems wrong.
Right. It's frustrating, right? This is like an ogre or like an onion or like a parfait. It has layers, right? And if you miss the first layer, then you're like, yeah, don't you love it? And then if you get that wrong, then you carry it through to down there, and then it's wrong down there. And then you're like, my students are always like, that's not fair. And I'm like, welcome to accounting and parenthood and life. But really, that's the nature of accounting is I call them cascading errors. If I make a mistake up here, it rolls. And we know what else rolls downhill. So anyway, I'll leave that to your judgment.
So then that'll finish up that cash of dividends and the dividends payable. And then it looks like you add those together to, do you add those together then to close out to finish up your retained earnings? What do you do?
Right. Yeah. So if you have a cash dividend of 199,200 and up here a cash dividend of 21,000, you're going to have a debit balance of 220,200 in your dividend account. So to close that cash dividend account, you'll credit it 220,200 and you'll debit that to retained earnings, which again reduces your retained earnings. Apparently that means reduces. I don't know. That's how my mom always talks. Hand gestures.
Okay.
Braden's like, let me type this in here right now, and I got it.
No, I'll
I
wait to
would.
do that. I'll wait to do that because my numbers are different. And if I'm
Right, I
trying
know
to
it would
do,
take too, it'd be too
I'm gonna
slow.
mix your numbers up with my numbers, and these are my last shots. These, this is attempt 3 out of 3. So,
I know when you get down to the last attempt, there's like
I know.
this nervous tension in the air.
So
Yeah.
this one's for the money.
Right, and that's what I literally just got done with that problem right before the meeting. So I haven't even got to the next section. Well, I started it a little bit to journalize it. So if you need help, maybe we can figure it out together.
Yeah, because my last one is the next problem. The only problem I had was journalizing the second one, which was the issuance of common stock for cash. Because it tells you the journal entries,
Right.
but then I got the first one to journalize for preferred stock, and I got the treasury stock good, but it was the common stock.
Okay, so let's look at this one again. Your numbers will vary from mine, but let's see. Concord Corporation authorized to issue 20,700 shares of preferred stock and 1.17 million shares of no par common stock. So this is a no par company. They've assigned a $4 stated value to common stock. Thanks, guys. Let's see. So all common stock was issued for cash. All right. So we are going to be issuing 1,170,000 shares. Sorry, I'm trying to figure out how many for the journal entries. All right. Sorry about that. So I just had to think about what this was. So here we show a common stock account of 1,995,000 and paid in capital in excess of 1,580,000. So to journalize that, I would start with saying, well, how much cash did I actually bring in from that issuance? 3,530,000. Oh wait, did I do something weird? I did something weird. 1,995,000. 1580. That's right. Okay, 3,575,000. Because I know that the amount of cash I brought in from issuing common stock is going to be the sum of the common stock and any paid in capital in excess of the stated value. And so I actually don't have to do the math because it gives me those numbers and I can just plug them in right there.
That was it. Because I think I was looking up at those 1,170,000, trying to figure out what to do with those, but it was already written there. So.
Right, and that's obfuscating, right? Because that's the amount that's the number that are authorized, but not necessarily the number that they're actually issuing.
Gotcha.
It's kind of a jerky question, actually. If they just throw an extra info in there to make it hard.
Sweet.
Do you think there's people as they write these that are like, this is going to cause people all kinds of grief?
Yes.
It's like a form of power. And then they're stroking a cat as they do it. This one's going to get them, my pretty. Yes, it will. All right. That was your last one?
Yeah, I'm going to survive this homework.
You got this. Aaron, are you good? You can answer in the chat if you don't want to talk.
No, I'm good.
Anne-Marie, you good?
Going through these problems has helped me a lot. Thank you.
Okay, great. Well, good. We've actually been on here almost an hour. See, time flies when I'm with good people. I know. So if you're thinking right now this really dragged for me, then I'm probably the weak link in that. So I apologize if it went fast for me and drug for you. It means I was the one who wasn't good people. Anyway, or at least I don't know if that might be false logic. Anyway, so if we're good, anybody any last chance, and then we'll say a prayer and let Braden get this like typed in there while it's still fresh in his brain. We'll let Tracy get back to all of her social media. Hey, guess what? You've probably been benefited by not having social media through this election cycle. It was just ugly and mean. So
Yeah.
Anyway, all right. Any volunteers for a closing prayer?
I'll say it.
Terrific. Thank you.
Our Heavenly Father, we're grateful for the opportunity tonight to discuss our homework, to clarify understanding, to be able to prepare for homework for the tests, and to hopefully take these concepts into our lives and apply them. We're grateful for Brother Fox and for his humor and understanding and willingness to help, and ask that those suffering can have their burdens alleviated, and that we can share knowledge and strength with other people. And these things we pray in the name of Jesus Christ. Amen.
Amen. Thank you, everybody. Have a great night.
Thank you.
Thank you.
Thank you.